Welcome back to the Deep Dive. It is Thursday, January 22nd, 2026. And today we are pushing the books and the big ideas to the side for just a minute. The market is just screaming for attention. So yeah, today we're firing up the stock screener.
We absolutely are. Usually we're looking at, a big macro trend or something, but today really demands a microscope. If you look at the tape right now, the volume is telling a very, very specific story. And that story is all about semiconductors.
All about semi. So we're zooming in on the top 3 stocks by volume on the entire market today. We're not just picking these out of a hat. These are the companies moving the needle. Like right now, we're going to strip down the data, give you a real journalistic report on the big 3. Intel, Nvidia, and Micron.
It's such a perfect storm of narratives today, isn't it? You've got this massive turnaround story that's, it's incredibly volatile. Then you have the reigning king of AI who's sort of taking a little nap, and then a memory giant that has just gone completely vertical, like a rocket ship.
Okay, so we're going to break it all down. We're talking fundamentals, technicals, the news that's driving things, valuations, all of it. But before we get into the weeds, I have to say this, and I'll only say it once. While we are using real data from today's market, January 22nd, and we're going to do some fun paper money math. This is strictly for informational and entertainment purposes only.
Right.
Neither of us is a financial advisor, and nothing we say today is investment advice. Please, do your own homework.
Always. Context is everything, and your situation is unique to you. So, yeah, never trade just based on a conversation you hear.
Okay, with that out of the way, let's set the stage. We're doing a little something new today, a paper money math challenge. For each of these 3 stocks, we'll simulate a $5,000 investment over a specific time frame. We want to see who actually put cash in the pocket, not just, percentages on a screen.
Oh, I love that. Because percentages are great, but dollars and cents, that's the language everyone understands. It really grounds the numbers in reality.
Let's not waste a second then. We're starting with the undisputed volume leader on the board today. Segment 1, Intel Corporation, ticker INTC.
The heavyweight. Or maybe the recovering heavyweight.
It is seeing massive, massive activity. I'm looking at the terminal. Intel has traded over 161 million shares today. For context, that is just a staggering amount of paper changing hands. Price is sitting at $54.32, up just a tiny fraction, 0.13%.
And that flat price is so deceptive, When you see that many shares trade and the price barely moves, it means there's a war going on between the bulls and the bears right under the surface.
Right, so let's dig into what's causing the fight. Intel's a $270 billion company, but the headlines are a total mixed bag. They just dropped their Q4 earnings.
They did, and it's that classic good news, bad news setup that just drives insane volume. The good news, they beat estimates for the fourth quarter. The turnaround plan seems to be finding some traction.
But markets don't care about yesterday, right? They care about tomorrow. And that seems to be where the trouble started.
Precisely. The bad news. After hours, the shares took a hit because their Q1 revenue outlook came in below what everyone was expecting. But more importantly, and I think this is what really spooked the market, they issued a specific warning about their operations.
The supply warning.
Yes. Management said, point blank, that chip supply is going to hit its lowest level in this first quarter before it starts getting better.
Okay, help me understand that. We're in a massive chip boom. How is Intel, of all companies, facing a supply trough?
It's a symptom of their massive restructuring. Remember, they're trying to do something incredibly difficult. They're trying to stay a top chip designer and become a top chip manufacturer, a foundry like TSMC. Their CEO, Pat Gelsinger, even said he isn't fully satisfied with the foundry side yet.
He's rebuilding the plane while flying it.
Exactly. He said they can't vacate the PC market, that's their cash cow, but they have to pour resources into building these new factories. And that creates these, air pockets in supply.
And the analysts are just completely split on this.
Oh, it's a total battleground. You've got Seaport Research upgrading them to a buy with a $65 target. Then you have HSBC coming in saying, hold on, with a neutral rating. That disagreement is exactly why you see 161 million shares traded. Half the market thinks it's a steal, the other half thinks it's a trap.
Speaking of traps, let's talk valuation. I looked at the screener earlier, and I seriously thought the data was broken. It lists the PE ratio at 5,124.
It's not broken. It looks like a glitch, but it's just math.
5,000? A normal PE is what, 20? 25? How do you even get to 5,000?
Okay, so PE is the stock price divided by the earnings per share, the EPS. If the earnings, the E, get really close to zero, the ratio just explodes toward infinity. And Intel's earnings for the last 12 months are barely positive, like a penny per share.
So you're paying 5,000 times a penny to own the stock. That sounds terrifying.
It does. It looks awful. But you have to look at the forward PE. That drops all the way down to 88.
Okay, that's a huge drop. But 88 is still pretty expensive, isn't it?
It is. It tells you the market expects earnings to grow a lot next year, but you're still paying a premium for hope. They're pricing in a perfect turnaround. And if you look at their margins, it explains the struggle. Gross margin is okay, about 35%, but their operating margin is negative.
So they're losing money on their core business before taxes.
Correct. They're spending so much on these new factories that they are technically operating at a loss right now.
Okay, so the fundamentals are scary. But then I look at the chart, the technicals, and it tells a completely different story. It looks like a rocket.
It really does. Intel is up almost 150% over the past year. And just in the last month, it's up over 47%.
So the price totally disagrees with the earnings.
It's a pure momentum trade. Investors are betting on the future and just ignoring the current lack of profit. The stock is trading way, way above its moving averages, 26% above the 20-day, 87% above the 200-day.
For listeners who aren't deep into charts, why does that matter?
Think of the moving averages like a rubber band. The 200-day is the long-term trend. When the price gets 87% away from it, that rubber band is stretched super tight. Eventually, it usually has to snap back or at least relax a bit.
And I see a flashing light here on the dashboard. The RSI.
The Relative Strength Index, it's sitting at 76.88.
And what does that mean?
RSI measures momentum. It goes from 0 to 100. Anything over 70 is considered overbought. It basically means the buyers might be exhausted. Everyone who wanted to buy has already bought. And when you see an RSI that high with a gap that big from the averages, it suggests the stock is due for a pullback. It's running really hot.
But wow, if you had ignored all that and just rode the momentum, let's do the paper money math.
Let's run the numbers.
Okay, this is a turnaround play, so let's look at the short-term scenario. You bought into the Intel is back hype exactly 1 month ago. You put in $5,000.
Okay, 1 month ago, the share price was about $36.82. Your $5,000 would have gotten you roughly 135 shares.
And today, even with the mixed news, the stock is up over 47% since then.
Which means your $5,000 investment is now worth approximately $7,376.
That's a profit of over $2,300 in 30 days.
That's just, that's an insane return. But again, it came with huge risk. You were buying a company with negative operating margins. You got to have the stomach for that.
High risk, high reward. Okay, let's pivot. Let's go to the other end of the spectrum. The company that has basically printed money for years. Segment 2, Nvidia, ticker NVDA.
The king.
Number 2 on the volume list, over 138 million shares. Price is 184.84, up a bit today. But the scale of this company, remind us the market cap.
It's staggering, 4.49 trillion with a T. That's bigger than the GDP of most countries. It's just the elephant in the room.
And the big news today is about a changing of the guard at their main manufacturer.
Yeah, this is a huge milestone. Nvidia CEO Jensen Huang confirmed today that Nvidia has officially overtaken Apple. They are now TSMC's single largest customer.
That feels really symbolic. For a decade, the smartphone was the center of the universe. Now it's the AI chip.
Exactly. Nvidia now makes up about 13% of all of TSMC's revenue. They're buying every single chip TSMC can possibly make for them. It shows that demand for their AI chips is not slowing down at all.
So why does the stock feel so sluggish? Compared to Intel's 47% month, Nvidia is basically flat this year.
It's the law of large numbers. When you're worth almost $4.5 trillion, it takes a truly astronomical amount of money to move the needle. But also you have to look at the financials. They're just pristine.
Let's compare to Intel. Intel had negative operating margins. How does Nvidia's shop look?
It's night and day. Nvidia's gross margin is 70%. Their net profit margin is 53%.
Wait, stop there. For every dollar of stuff they sell, they keep 53 cents as pure profit.
Yep. That is basically unheard of for a hardware company. Usually hardware is a grind, But Nvidia has so much pricing power, they charge software-like margins for physical things.
So is it expensive?
Yeah.
The PE is about 46.
Which is, historically pretty reasonable for them. But here's the deep dive stat. Look at the PEG ratio.
PEG, price to earnings growth.
Right. It compares the PE to the expected growth rate. And a PEG of 1.0 is considered fairly valued. Nvidia's PEG is 0.48.
Wait, a peg under 0.5. That usually signals a stock is massively undervalued for its growth rate.
That's what the math suggests. It's saying that despite being a $4 trillion company, if they hit their growth targets, the stock is actually cheap right now. The market is pricing it as if the growth will stop, but the peg says if it continues, this is a bargain.
That is so counterintuitive. So why is the chart just sleeping?
It's consolidating. The stock is down a tiny bit year to date. It's trading just below its 20-day moving average, and the RSI is 50.3.
Dead neutral.
Dead neutral. Not overbought, not oversold. The market is just digesting the huge gains from the last 2 years. Traders call this a coil. The price is compressing, getting ready for the next big move.
And it's about 12% below its 52-week high. So it's kind of sitting in a waiting room.
The waiting room is a perfect way to put it. Smart money often prefers the waiting room to chasing a rocket.
Okay, paper money math for the king. This is a long-term hold for a lot of people, so let's look at a one-year time frame.
Right.
Scenario. You put $5,000 into Nvidia exactly 1 year ago, and you just held on.
1 year ago, the price was about $140 a share. Your $5,000 gets you about 35 shares.
And the stock is up 31% since then.
So your $5,000 is now worth about $6,562.
A profit of around $1,500.
Look, in any normal world, a 31% return in a year is fantastic. It crushes the S&P 500. But compared to the other two on our list today, Nvidia is actually the laggard.
Wow, that just highlights how aggressive this sector is right now, when 31% makes you the slow one. Okay, let's get to the speed demon. Segment 3, Micron Technology, ticker MU.
The rocket ship.
This stock is moving. It's number 3 on the volume list, but look at the price, $397. It's up over 2% today alone, the biggest mover of the group.
Micron is absolutely having a moment. It's a $447 billion company now, but it's trading with the volatility of a startup.
What's fueling the tank today?
2 big things. First, analysts are chasing it. William Blair started coverage today with an Outperform rating. Their whole idea is simple. This AI cycle will last for years, and memory is the bottleneck.
And second, they went shopping.
They did. Micron just announced they're buying a factory in Taiwan for $1.8 billion.
That connects right back to the Intel story, doesn't it? Everybody is scrambling for more capacity.
It does. But here's why Micron is so critical. You can have the fastest Nvidia chip in the world, but if you can't feed it data fast enough, it's useless. And that data travels through memory.
So Micron sells the pipes that feed the Nvidia brain.
Exactly. And right now, the pipes are way too small. Demand for high bandwidth memory, HBM, is just overwhelming the supply. That's why they're buying factories. They need to make more, like yesterday.
Okay, here's where my brain starts to hurt. The stock is near $400. It's had a massive run. It must be incredibly expensive.
You'd think so, right? This is the aha moment of the whole deep dive today. Look at its forward PE ratio.
I'm looking at it, 9.27.
Single digits, 9.27.
No way. How? Intel's is 88, Nvidia's is 24, and the rocket ship is trading at 9.
It implies the market thinks Micron is just unbelievably cheap compared to the money it's about to make. Earnings growth is expected to be explosive, over 31% next year. The PEG ratio is 0.13.
0.13. That's almost absurdly low. It sounds too good to be true.
It is remarkably low, but you have to be careful. Memory is historically a boom and bust industry. The market often discounts these stocks because they're afraid the bust is right around the corner. But with AI, the bet is that this is a super cycle that won't bust.
So the fundamentals say buy, but I'm looking at the chart and it looks like a cliff edge.
It's terrifyingly steep. Micron is up 263% in the last year. It's up almost 40% just since New Year's Day.
It's trading 139% above its 200-day moving average, that rubber band we talked about.
Like
Something to snap.
It's stretched to the absolute limit, and the RSI is at 78.48. That is very overbought, even hotter than Intel was.
I also see a note here about a candle pattern, a dragonfly doji.
Yes, that's a specific shape on the chart that looks like a T. It signals indecision. When you see one of those at the very top of a huge run, it can signal a reversal is coming. The easy buying might be over.
So you have a fundamental value, that cheap PE, fighting a technical warning that overbought RSI. A tough spot.
It's a classic conflict. The value investor sees a bargain, the chart trader sees a dangerous top.
But for the investor who got in a year ago, it's a victory lap. Let's do the final paper money math, the big one.
Let's see it.
Scenario. You saw this memory bottleneck coming exactly 1 year ago. You put $5,000 into Micron.
1 year ago, shares were about $109. You would have bought roughly 45 shares.
And with a 263% gain.
That $5,000 is now worth approximately $18,174.
Oh.
That is a profit of over $13,000.
In 1 year. That is the clear winner of our challenge. It just blew the other two away.
It really shows that sometimes the best play isn't the obvious one like Nvidia, but the pick and shovel play that supports it.
Incredible. So let's bring it all back home. We have Intel, the turnaround gambler, $54, huge short-term gains, but scary fundamentals.
Then Nvidia, the steady hand, $184 stock, amazing margins, but taking a nap in the waiting room.
And finally, Micron, the rocket. Almost $400, up 260%, flashing warning signs. But it's still somehow cheap on paper.
It's a perfect cross-section. But if we connect the dots, what is the volume telling us?
It feels like the market's obsession is shifting.
It is. For 2 years, the story was just buy Nvidia. Buy the brains. But look at the volume today. The market is screaming about infrastructure. It's worried about the body of the AI, the memory from Micron, the manufacturing that Intel is trying to build.
The bottleneck isn't the smarts anymore, it's the plumbing.
Exactly. And that leads to the big question I want to leave everyone with today.
What's that?
Look at the valuations. Micron's trading at a PE of 9. Intel is warning about shortages while spending billions. The market is pricing the boring stuff very differently now. So are we entering a phase where the commodities, the memory, the factories actually become the most valuable part? If AI demands infinite memory and infinite chips, maybe the power shifts from the chip designers to the chip makers.
That's something to think about next time you see a sold-out sign on a graphics card.
Yeah.
It might not be the GPU that's missing. It might be the memory attached to it.
Precisely.
Thank you so much for joining us on this deep dive into the numbers. We hope the paper money math gave you some perspective.
It's been a pleasure.
Check those portfolios, keep an eye on that volume, and remember, do your homework. We'll catch you in the next one.